Well, it's amazing what happens in a week, guys. We record our podcast on a Tuesday, and by Thursday of last week, markets basically went into mayhem. And it's funny, a lot of the points we made on our podcast last Tuesday were very relevant. We were talking about a sell-off in the markets, but at that time, I don't think we realized just how aggressive the selling was going to become. And to see the market lose like 10% plus, depending on the index, over the course of 3 days, like, ouch, that hurts a lot.
Yeah, and I thought what was interesting is if you saw a lot of these reports about retail traders have been buying into all the dips. And this is what we keep saying is through all of these downturns, our clients keep saying, oh, should we buy into these as an opportunity? Which we kept saying, is that a bad sign that there could be more selling to happen? And obviously that happened last week. There was a report that came out that showed that retail traders actually stopped buying into and actually started selling out of the markets last Friday, which hopefully is a good sign. You saw a volatility spike. People are selling out of the markets. The panic is set in. Hopefully that means we're getting more toward an end of this. I don't know if we actually are, but I think you're seeing some signs there, which is a good thing.
Yeah, that's a good point, Courtney. And I'm already starting to notice that with our clients too. As I'm talking to them saying, listen, a lot of the things in our portfolio are down for the year. We've held up a lot better, but at some point, if this continues to slide, we're going to take money out of bonds, which are up, and buy back into the market. I'm getting a lot of pushback on that right now.
Yeah, well, that's a good sign. Whatever your clients want to do, and you can do the opposite, always. And I love my clients. But yeah, right. And when people want to buy in, it probably means it's going lower. When they don't want to buy in anymore, it probably means you're near a bottom. And I think it just gets scary, right? I mean, let's face it, the last couple of days were really scary because you didn't know what was going on. We saw prices just like literally drop. And a lot of it's because of basically leverage, right? A lot of these hedge funds, we look at a lot of portfolios on a monthly basis. A lot of investors were all in the same trade, whether it was on the Magnificent Seven. We talk about this a lot in our podcast. They own those artificial intelligence stocks. They own a lot of leveraged ETFs where you're getting double the upside or downside. So when the market goes against you, all of a sudden, these hedge funds have to start selling, right? And they're forced to sell because they get what you call a margin call. And a lot of individual investors were in the same boat. So it just becomes a bloodbath and everything just sells off into like oblivion. And that's really what we saw the last couple of days. So first off, the thing you don't want to do is obviously panic because you're almost getting artificial pricing on the downside because you have people that are getting forced out of the market. So I think bottom line is just you've seen a lot of leverage being unwinded here, and that's just pushing prices down to artificially low levels.
And that's what the markets tend to do, right? They're going to overshoot in both directions. So we saw this earlier in the year. We were kind of arguing that markets were artificially high and overly optimistic. And now they're probably overly pessimistic. And the reality is probably somewhere in the middle. But you're exactly right. The best thing you want to do is either stay invested or buy. You don't want to be selling at some of these prices. So I think this is a good reminder. But when you look at the last 20 years, 24 of the best 25 days happened within a month of the worst days. So when it is the hardest to be an investor, you need to stay in because those rebounds come just as quickly.
Boy, this is really starting to feel like 2020, in March of 2020 when, Court, I don't know if you remember, every day we were on the phone with clients just trying to keep everybody in. And Ryan and Bob kept saying, we're going to have a V-shaped recovery. And you know what? Sure enough, that year was incredible. We had a V-shaped recovery.
Yeah. Hey, I mean, it's possible to have that again, right? I mean, because this is kind of like like the pandemic, it's self-induced, right? The government shut down the global economy back in 2020, and what you're seeing right now is the same thing. We're self-inducing, putting all these tariffs on other countries that are impossible tariffs to actually do business with, and businesses don't really know what to do right now, so it's put everything at a standstill. But the reality of it is there will be negotiations. Business tends to get figured out somehow, especially in the United States. And once you figure that out, I mean, you have a lot of catalysts here that are probably going to push the economy higher and the market higher. And, I would say like the fact that we have lower oil prices now, interest rates just went down. Like my good friend just called me yesterday and told me he refinanced his mortgage. So that actually becomes a stimulus for the consumer. And we know in the US, the consumer drives like everything.
Yeah, and I think a lot of times, like you hear in the news, like a lot of this, like you were saying, Rye, a lot of this great positive information is not really being factored in. There could be a lot of opportunities for some good news to come out, and we just need a little bit of that, and the market will shoot right up.
Yeah, it's interesting. We have a lot of clients who are business owners, CEOs, and I've actually been talking to a lot of them, like, what are you guys doing in your business in reaction to this tariff news? And really everybody's saying, we don't know. We don't know what's actually going to pan out with all this. We're not changing our business yet. But what you're seeing is the markets are trying to price in what could possibly happen and probably worst case scenario. So you get any surprise of the positive. I think there's probably more surprise of the positive than the negative after you get that kind of reaction.
And it creates a lot of pent-up demand because I think the key here is businesses are on hold, right? They're not canceling their plans, they're on hold. So, once there's clarity and it looks like there are negotiations, as we're recording this, negotiations between different countries, the US and different countries is going on, at some point that is going to give the ability for business to say, okay, like we can start spending again on capital expenditure. We can start selling our goods again. And I think that's all we're waiting for here. And again, besides that, we look at the economy before the tariff turmoil. Things looked really good. I don't think that's changed, right? We've got more deregulation coming in. We should continue to have the tax breaks or extension of the tax breaks that we had from Trump's last presidency. We know the earnings picture was very good. And people have jobs, low unemployment, and people are spending money. I was in Soho this weekend. I can tell you, judging by what's going on in Soho, people were worried about tariffs. There's a lot of people buying a lot of goods here, and Americans love to buy goods.
Yeah, that hideous pair of pants you bought, was very expensive. So you're really stimulating the economy. Great job, Brian.
I was shopping this weekend. And I think that's really what it comes down to, right? Is it going to deter people from making purchase decisions? And I think it has postponed maybe, but look, the analyst spirits can go back really, really quickly. They left quickly. They can come back quickly. And I think that's what you have to bet on as an investor is things are going to get better, not worse from here.
Yeah, I was talking to a friend of mine last weekend, and she was saying how horrible things are. And then she went into a rant about how many places they're traveling to this year, places like Australia and Europe, places that aren't cheap to get to. So, never underestimate the U.S. consumer.
When you look at the consumer savings rates have ticked up. So I think to your point, Ryan, whether the consumers are pushing off purchases, it's not necessarily that they're in a worse position, but they're saying, I don't know what's happening either, just as much as businesses don't. And so they are pushing off a lot of those big purchases right now. And you could see some of that come back in.
Yeah, and I think two other really important points here are, you got to have hedges in your portfolio. If you haven't learned now that concentrating your money in one place, you live by the sword, to die by the sword. I mean, let's face it, our portfolios were down maybe a couple percent at the worst, only because we all have big bond portfolios for our clients and bond prices went up, which was a huge hedge, which brings up another point right now is if you've been sitting in a money market fund, that wasn't a great hedge because interest rates keep going down, means your money market rate keeps going down. Whereas if you lock into a bond portfolio, well, you actually had a better yield and the prices went up. And the other part of this is, Chris, I know you're talking about this a lot, is everyone wants to buy into the same stocks that just got crushed. That might be a big problem. That might be a big mistake.
Yeah, I mean, if you look at that, the valuations, I mean, even with those prices being suppressed, the valuations are still ridiculous. I mean, on the other hand, you've got things like emerging markets, which pays a great dividend, international stocks which pay a great dividend, global real estate pays a great dividend. It's dirt cheap right now. That's the real value for your money. And that also adds a nice hedge to your portfolio because it pays dividends.
Yeah, and a lot of these are also defensive sectors. So what you see is people tend to sell all of those overly valued, high-priced stocks and move into kind of your boring, safe, value, dividend-paying companies. And it's just another reason why, especially in this kind of environment, you need to own some of those as well. Because if that big rotation happens out, you need to make sure you have that to hold up your portfolio, which is exactly what's been happening.
Yeah, and I think that's a good point, Courtney, because nothing really does grow to the sky. I mean, if you look at the previous 10 years before growth stocks did well, they didn't do anything for 10 years. So,
and that's the other big point here, I think, is the fact that when you have these big moments of volatility, the leadership can change. Like what rebounds may not be the winners of the last year. And we saw this after the dot-com bubble burst, is those tech stocks didn't come back. But meanwhile, small cap stocks did really well and emerging markets did really well. International did really well. So you have to anticipate there will be some sector rotation, which we already saw at the beginning of this year. So I think more than ever right now, the best thing you can do is, if you're concentrated in one area of the market, don't double down on it. Spread out your risk. Always have a big bond portfolio. Don't sit in cash. It's not as good a hedge as a big bond portfolio that comes due. So you have a great opportunity right now to be proactive, not reactive. Take advantage of the volatility. Get properly positioned for the upcoming rally that's inevitable at some point here in the future. Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million,
Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, brokerage product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review.
All right, it's a tipping point. This is where we pinpoint the pain point. Of course, that's Payne, having the biggest impact on your wealth right now. And this week, guys, I thought we would do another financial autopsy. I like that better than our spotlight name. Our interns in the office came up with it. Kudos to the marketing interns. Where we break down a real case. And I think right now is a good time to talk about that because I think a lot of people are wondering, okay, my portfolio sold off a lot over the course of the last couple of days. Do I sell here? Do I go to cash? Do I put more money to work? Am I taking enough risk? Am I taking too much risk? So, Chris, I think a case that you worked on recently is a good illustration of a lot of the mistakes I think a lot of people are making right now, and basically how you were able to correct it to help this specific couple get on their path to financial independence. So why don't you break down the case for us and we can do a real autopsy?
Yeah, so this is a couple that they're in their 70s. They've accumulated enough assets to last them the rest of their life. You know, they're basically set for life, but they have a portfolio that's not getting them towards that goal. You know, on one side, they have all their money in money market, and then on the other side, they have extremely speculative, you know, large growth technology stocks, which just gotten absolutely hammered the last couple of days.
Well, I'm sure they're feeling pretty good about their cash position right now, right? It's nice to have that when the market sells off, like, depending on the index, you know, anywhere from 10 to 20% in a 3-day period. Ouch. But the money that they do have in the market, I'm looking here, they have all the stocks that just got crushed, for lack of a better way of putting it. You know, whether it's Tesla, Amazon, Palantir, you know, just huge multiples, just going up the most over the course of the last year. But as we like to say here, Payne Capital Management, right? It's like you live by this sword, die by this sword. And I'm curious, Court, like with a lot of the portfolios that we review, do you see a lot of this where maybe people have too much money in cash on one hand, but the money that they have risk, way too much risk with the money they have at risk? I feel like this is a very common theme that we've seen with a lot of portfolios.
This is really common. And actually, I think the biggest thing that stood out to me here was how much they have in cash, Chris. Maybe you can talk about this a little bit, but having money in safety is one thing, but making sure that it's at least locked in so you're getting the good interest rates that are available is great. But they have a lot in money markets, which means they're floating rates. And if rates are coming down, which they are, that's going to come down. But also, are these in taxable accounts? So are they paying taxes on this also? Because the income actually looked good at first sight. I'm just wondering, when you actually break all those things down, is it as good as it seemed?
Yeah, I mean, it's got a great wrapper, right? It's like they're getting 4%, you know, on a lot of money. They're making a lot of income. But yeah, you make a lot of good points. One, that rate's not locked in. So if interest rates start to go down, which they probably will, they're going to make less money. But yeah, they're in a high tax bracket right now. And all that money is in taxable accounts. So, you know, that 4% after taxes is probably like closer to 2%. Not to mention, they're in a really high tax state.
Yeah, well, actually, it was a mistake because, right, the bond market did much better than sitting in cash over the course of this last sell-off, right? Because the problem is the money market fund, which we warned about last year, was at 5% a year ago. Now it's under 4%. So if you've been sitting in cash, your interest rate's been going down, down, down. Had you locked into a bond portfolio, not only did you get the higher interest rates on that money, but interest rates came down as the market sold off. So our bond prices actually went up, which is a huge hedge when you have a market sell-off. I mean, put it in perspective, like how much was the S&P 500 down over the course of the last couple of days? Do you know what the percentage was?
We're recording this on a Tuesday. So through the end of Monday, the S&P was down about 14%.
Right. Our diversified portfolio was down like 2.
Correct.
The
Correct.
reason being is not only do we have bonds, but also having other types of investments in your portfolio. And we preach this a lot because the other problem with this is every stock in this portfolio, they're all part of the same trade, right? They're all part of that high growth trade, somehow related to artificial intelligence, what we call growthier stocks. But meanwhile, on this sell-off, if you look at what was down the most, it was those stocks, whereas like international developed markets have held up better. If you look at value stocks, they've held up better here. Commodity prices held up better here. And again, if you had a huge bond portfolio to offset that risk, you really mitigated the downside in a big way. Like we had people calling us being like, oh my God, my hair's on fire. The market's down. But we're like, well, you're only down 1%. And they're like, really? But this is why diversification is so key. And even sitting in cash is not a great hedge when the market goes down. This is case in point.
Yeah, I mean, I guess the bright side is that, sitting in cash does give him the opportunity to get back into the market while the market's low. The wind is at his back right now. But, the hard part is taking action. I mean, how many times, over the last couple of days, Courtney, have you and I called clients where we're saying, hey, here's our strategy. We're going to buy back into this thing and gotten so much resistance.
Absolutely. Because everybody is very nervous that there's still going to be another leg down. And there could be, but if you have cash, this is a great time to get it to work. And my gut instinct when markets are down like this is to buy into it. But the problem is most of our clients are not very off balance right now, which is good. Like they're not down that much, which is where if you have cash, that's this perfect opportunity of let's start to get some money to work if it's sitting there.
Yeah, but my fear is I think if someone like this who has been sitting in cash, they've been fearful. And now they have this quote unquote dry powder, which like, let's be real. It's a really good time to buy. Are going to keep thinking like, well, I've been smart so far. Let me just wait and see what happens here before I put the money to work. And then it becomes paralysis by analysis. And this is where I think, investing your money based on your goals, just as opposed to based on your feelings. Chris, I'm curious, why do they have so much money in cash, right? Of this whole portfolio, the vast majority is in cash. Clearly, this guy's close to retirement, right? He's going to look to live off this money. Did he give you a reason for why he had such a huge cash position?
Yeah, so the reason that he reached out to us is that he and his wife are never going to need this money for their lifestyle. They've got enough income coming in to take care of them. The real reason was that they wanted to have money for the next generation and the generation after that. And one of the things that he realized is that having so much money in cash is not going to do that for them. And that scared him.
And I think that's so important for people to understand is you want this money to be growing for you, but especially in a case like this where maybe some or all of your money actually could be going to your kids, it's more of a reason why you don't want to just sit in cash because it is going to eat away from things. And you want to make sure that this is growing not in the next year, but the next 5 years, 10 years down the line for your grandkids, that it's going to be worth more. And the best way to fight inflation is by at least having some in the markets to grow. But that safety money, probably getting that locked into interest rates is a better plan.
Yeah, and I think right now it's the worst place to be because there's always this fear that inflation is going to go higher, and we just lived through a high inflationary period. But meanwhile, your cash interest rate is going down. It wasn't like when inflation went to 9%, but your money market fund yield was going up. You have the exact opposite going on right now. It's going the other way. And Chris, another interesting point I think here too is the problem with this portfolio is this guy has all his money in a money market fund where all the interest is taxable. And if I understand it correctly, he's in a high tax bracket. So he's paying federal tax on that, let's call it less than 4% right now interest rate. And if you factor in inflation on top of that, I mean, he's actually not making any money. Meanwhile, if he had a big tax-free bond portfolio and he's in a high tax state, all the interest that he'd be generating would be completely tax-free, even though the yield's a little bit lower. What he puts in his pocket is much higher. And I think this is the other analysis most of us don't run. We don't actually look at what is our return after taxes. And it's not what you make, as we like to say, it's what you take. And I think this is a perfect example of someone who didn't realize that like they're paying taxes on all this money and doing it in like the worst state to be paying taxes in.
Yeah. And I always say you get a better outcome with income and you get more income by not paying as much in taxes. Not to mention, all the stocks that he owns, they don't really pay any dividends. So he's not getting any dividend yield off of his equity portfolio, which, if you think about where he's going to get most of his growth, it's going to be there. And having an increasing dividend paying portfolio, that's huge.
Great point, because when the market's going down, those income payments still come in, right? So that's the key here, especially if you're going to live off your portfolio. It's different when you're working and you're just putting the money away. But at some point in the future, like now, even with the tariffs going on and the sell-off going on, last time I looked, those dividend payments are still going into our clients' accounts. And that's what you need, that consistent cash flow, especially when you're going to live off your money.
Yeah, and that's going to help him achieve his goal of passing money on to the next generation. Right? I know how important inheriting money is to you, so I feel like you would really resonate with this case.
Sounds like I'm in the will, Courtney. I hope.
You guys need Bob here so you can give him a hard time about your inheritance.
He'll
listen to the replay. Yeah.
He'll listen to the episode. All right, it's a hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Chris. Well, gold beat the S&P 500 by more than 20 percentage points in the first quarter of this year. That has happened only 12 other times in the past 50 years. According to Bespoke Investment Group, Costco sells 1-ounce bars. Although members can only buy a handful per transaction, you then need to store it, ideally not at home, but in a bank safe where fees can add up over the years. Is this a sign of a top when they're selling gold bars at Costco? I feel like it kind of has to be.
Or the many thousands of emails that I get every day about the opportunities to purchase gold and patriotic gold coins. Yeah, I think so.
Yeah. Well, it's had a really good run, I guess, over the last 10 years. But if you go back to 1980 in inflation-adjusted terms, it's only a little higher than it was. So over longer periods of time. But I will say it is a great diversifier. Like right now with the market down, gold has actually done really well. So it has what we call low correlation to stocks. But other than that, and then maybe there's a necklace around the one that you love, gold is not a great long-term investment. Courtney, one of the worst performing investments in 2025 so far is the $3.5 billion Direxion and Daly Tesla Bull 2x shares exchange traded fund, which plummeted 70% recently. Although it rose 102% in 2024's fourth quarter, propelled by President Trump's election, if you held it through the end of the first quarter, you're now down over 30%. Man, oh man, leverage, owning a very, very overvalued stock, Court, is a recipe for disaster.
Yeah, and it's just a good example of really what we've seen this year, where people are now worried about a recession happening, a slowdown in the economy. And the first thing that people get out of are those high valuation tech companies. And Tesla is just a really good example of that, where we talk about how expensive the market is. That is one of the most expensive, which trades at over 100 times next year earnings. It is, right? It's the most expensive of the Mag 7, right?
It definitely is. But Corey, you don't understand. It's a technology company, not a car company. Even though 90% of their revenue comes from selling cars. You got to remember that. No, it's crazy. And just the fact that then you just add double leverage on top of it, meaning you get double the move up or double the move down, which is great when it's going up. When it goes down, leverage always hurts you more than it helped you. And I think that's what a lot of investors are learning right now, is how painful leverage can be on the downside, because a lot of investors didn't go through 2008, 2009, where leverage just killed investors. Well, I hope you enjoyed episode 199, almost 200, Payne Points of Wealth. If you like our podcast, you love our podcast, please don't give us a secret. Let people know about the podcast. Give us that 5-star rating on iTunes, on Spotify. If you're watching this right now on YouTube, you can like this episode. Subscribe to our channel. Click that notification bell to be updated every week of all our new content. Your support gives us the support to continue to do this podcast. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at BeBullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.